Hello, 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 and welcome back to another episode of Freedom Ain't Free. My name is Joel Huey, and today we're going to be discussing insurance for your 401k, the new diversification formula for your qualified plan strategies. And the reason why I wanted to share these ideas and concepts is as I've been looking at things that are kind of going on in the market. We've been dealing with inflation, which is basically the rise of prices. We've been seeing the markets soar to levels that we've never seen before, with the price to earnings ratios of companies trading at 4 or 5 or 6 or 8 times earnings. We've seen conversations and talking about the currency, our dollar system here in America, moving from one strategy to another strategy. And when you begin to add these pieces of the puzzle up, when we look over at the real estate market and we see housing prices getting to the point where, average, regular, middle Americans not going to be able to afford a new home, these pieces of the puzzle all come together and let us know that the market is nearing a time to make a correction. We cannot stay in these heightened states for very long. And the example I always like to use when you're just kind of thinking about is the way your body works, right? If you go and you work out, you cannot work in a high intensive training every single solitary workout, right? You have to allow your body time to rest. Well, we have to allow the market a time to rest and a time to reset. So, with that being said, we need to look at a different diversification model. Now, if you have large sums of money, there are different strategies that you could use to take advantage of market downturns. There's options, there's puts, there's different strategies and things you can do with your cash if you have a lot of money. But for those who we typically serve, we like to refer to you guys as Henrys. So we're high earners, but we're not rich yet, right? We figured out how to move our incomes up above $100,000 a year, but we're just now kind of getting enough money to be able to save and invest. So we haven't quite amassed the capital necessary to utilize the diversification strategies of the ultra wealthy. So what I wanted to talk to you guys about today is the diversification strategy that will work for us. But before we get into the actual strategy, let's talk about what diversification means to most advisors and most of their clients. And then I want to share with you a different definition of diversification. So, generally speaking, when you're talking to the average advisor and you're talking about diversification, they're going to be talking about a split between what we'll say in a big broad category of stocks and bonds, right? Most of us are doing mutual fund investing. And so within the mutual fund, you'll have a stock fund or an equity fund, and then you'll have a bond fund, right? So again, remember, a stock is you buying ownership into the company, and a bond is you loaning money to the company. Company pays you back with a predetermined return. So that's the difference between a stock and a bond. Mutual funds, you don't actually own the stock or the bond. You own a share of the fund, right? So I encourage you to check out my video on the direct indexing strategy. It's a way around that where you can actually own the stock and own the bond and have all of the same benefits of the fund and all of the added pieces of the puzzle for yourself. But within true most of the time diversification, you're buying mutual funds, right? And within that mutual fund, you have the equity funds or the stock funds, and then you have the bond funds, right? So when most people talk about diversification, they're talking about some of their money in mutual fund equities, some of their money in mutual fund bonds. Now, within your qualified plans, most employers have adopted what's referred to as a target date fund. A target date fund is a combination of stocks and bonds that's set on a predetermined cycle to automatically move your money from equities over into bonds, basically set on a year basis. So once a year at some predetermined point, they move a certain percentage automatically from your stocks to your bonds. Now, the reason why that's not a great strategy is because we need to be paying closer attention to what's actually happening in the market and make our market timing not just a date on the calendar from a timing perspective. So these are most diversification strategies. When you look at your mutual fund investing, most investors have their money in multiple equity funds and multiple bond funds. But once you really understand the difference between an equity fund and a bond fund, you'll find that there's not really any need to have multiple equities and multiple bond funds. They're basically doing the same thing. The way you can understand that is by looking at the top 10 holdings of the different funds. So you're looking at an S&P 500 index fund and a large cap, a large cap fund. You're going to find that basically most of the funds in those two cases are actually going to the same company. So if that's the case, that's really the same fund with a different name, right? So if we really just break it down, you got your equities and you got your bonds. And most of the time, you're going to get a 60-40 split recommendation, which means 60% of your equity, 60% should be in equities, and 40% you'll put in bonds. That is a standard diversification model, right? So the problem, in my opinion, with that is you misunderstood the idea or concept of diversification. And the way I like to explain diversification is by making a reference to my wife's shoe collection, right? So she has well over 100 pair of shoes, right? And she only has 2 feet, right? So what does that mean? That means she can only wear 2 shoes at the same time. So diversification, right? She's not going to wear her high heels out to play basketball in, right? She's not going to wear her athletic shoes, her running shoes, out when we go out on the town to have a night at a gala or something formal along those lines. She has a particular shoe to do a particular thing. When you're looking at your portfolio, I want to encourage you to think of it the same way. You want to look at the individual pieces of your portfolio, and you want to have a piece of your portfolio doing something different. They're disconnected from each other totally. That way, if something happens over here, it didn't affect the other buckets and the other parts of your overall formula. So the thought process is I don't have all my eggs in one basket, right? So when we start talking about this new formula, and I want you to stay to the end so you can get the new formula, but when we start talking about this new formula and this new idea, it's going to be based on product diversification, not just spreading my money across 3 or 4 or 5. I've seen some cases 7 or 8 different mutual funds. That's not diversification. That's just having all of your eggs in one carton, but that carton's doing the exact same thing. Now, why do you need to change your diversification model? Let's talk about that. So when you look at what's going on and you look at the market preparing itself to reset, and I'm not into doom and gloom, right? That's not who I am. There are good points to the market resetting itself. There are bad points to the market resetting itself. What I want to do is equip you to make the best decision for you. There's a difference between the economy and your economy, right? And here at ARC Financial Strategies, we focus in on your economy, your specific situation. But why do you need to change? So the reason why you need to change is because you can get the money back. The market crashes. Some people like to use that word. I like to use reset. The market resets itself. The price of your mutual funds is going to decrease, but the market is going to rise again. So if you just hold on, the market will reset itself and it'll begin to make the climb back up. So that's where you get, a lot of people get excited when, the market is on its rise again. The problem is that you have to survive the market's resetting, right? You have to survive the decline. And the reason why I'm telling you to change your diversification model is because you can't get the time back. You can't get the time back. You can get the money back. The market will reset and it'll grow again. But you can't get the time back. So depending on what your time frame is for financial freedom, and here at ARC Financial Strategies, we define financial freedom based upon income, right? So if you have a $2 million portfolio, with an 8% return, you have $160,000 a year coming from your portfolio. You are financially free. The trouble is that if you take a market reset, and that derails you for 1 year or 2 years or 3 years, you've lost that time, and that's 3 more years of working to get before you could get yourself to financial freedom. So this is why we've come up with the new diversification formula for you that's going to shield you from the next market reset and allow you to weather the storm the best way you possibly can based upon your financial situation. Now, if you want some more information, you want some details, you want us to work with you on a one-on-one basis, click in the description below, schedule yourself a free consultation. I'll give you your freedom number, tell you exactly how much money you need to save on a monthly basis for you to get that $2 million portfolio and get to financial freedom. Now, here we go. The new formula for diversification for you. So it's going to be broken down into 3 different buckets, right? 3 different pieces of the formula, 3 different separate containers to house and hold your money. So the number 1 container is going to be cash. The number 2 container is going to be an inflation protection tool. And the number 3 container is going to be your volatility protection tool, right? So you want to put together 3 individual strategies to help you weather the storm the best way you can, and then also take advantage of the volatility opportunities without actually ever taking on a full amount of risk. Because what we're trying to do is protect what we have. We want it to continue to grow. But until we get that $2 million portfolio, we don't want to go backwards and we don't want to lose time. So here's the new formula for you to consider in your overall diversification model. Cash. How much money should be sitting in cash? 25 to 30% of your portfolio should be sitting in cash, right? So whatever tool you're using, whatever strategy you have, so within your 401k plan, look through the options, and they'll typically have a fixed account or they'll have a money market account where you can rest a percentage of your 401k in actual cash, right? So that's money that's off out of the sidelines, and it has no chance of being lost, right? Secondly is an inflation protection strategy or an inflation protection tool, right? So you want to look for or add to your 401k strategy either some fixed products, right? So that's going to be a CD, that's going to be a fixed annuity from an insurance company that's going to give you a guaranteed rate of return. So typically be a little bit higher than what you're going to get in that cash account or that savings account, right? So reallocate money that you were funneling into your 401k and take a percentage of that and move that over into either, if you're going to stay inside your 401k, then you want to look for a fixed account option, something along those lines. If you're going to move it outside, look for a CD, look for a fixed annuity, or you can even use an index annuity strategy because there's no principal loss within the index annuity strategy, right? So those are some pieces of the puzzle. Lastly, within your 401k, you can look for a precious metal ETF or really a gold specifically, a gold ETF, right? So if in your 401k you have the option of buying gold, inside of that, put that into that strategy, right? That's going to give you inflation protection, right? What is inflation protection, Joel? So what we want to encourage you to do is be on the lookout. Check our space on the channel. We're going to open up our school community in about 2 weeks, and that's going to give you an opportunity to sign up for our school. And inside of the school, I'm going to walk you through all of these terminologies, all of these individual pieces of puzzle. I'm going to give you a complete do-it-yourself program inside of our school community. So make sure you connect with us so that you can get the information about the school, right? So you want inflation protection, that's going to be a separate account, or you can look for a gold ETF inside of your 401k. Those pieces of the puzzle are going to protect your money from losing its purchasing power. Now, number 3, as we wrap up today, is your volatility protection, right? You have got to learn how to take advantage of the market decline, right? So there's money to be made in the market with the market going up, and there's money to be made in the market with the market going down. Now the trouble is we don't have enough money to go into the puts and the options in order to take advantage of this volatility, right? But there are ways for us to work together as a team in order to get those access to that volatility protection. So I want to encourage you to look into an indexed universal life policy, or a variable universal life policy, or you can look into an indexed annuity or a variable annuity, right? So basically, you are partnering with the insurance company. The insurance company is taking your money. They're buying options and puts, right? So they have hundreds of millions of dollars. They're buying options and puts on whether the market's going to go up or the markets are going to go down. They have full-time professionals who are doing nothing all day long but studying these market trends, and they are banking on the market making an adjustment one way or the other. So you get to take full advantage of market volatility without actually taking on any principal risk, right? None of your money is in risk. If the market goes down or their strategy fails, the insurance company takes the entire loss. If the market is up, you get to share in the profits because you gave the insurance company the money to play in the game. This is how us Henrys, high earners not rich yet, are able to play in the same game as the big boy without having the money that the big boy has to play in the game. Now, we're going to wrap all of that up, and the final piece of your new diversification formula is once we begin the transition and the market begins to reset, the market moves into crash, what you're going to see is prices are going to start dropping, specifically real estate prices, right? So why did I tell you to have 25 to 30% of your money in cash? Because you want to be in a position, borrow out of your 401k and buy you some dirt, right? So one of the things we say at our financial strategy is God's not making any more air or any more dirt. So we want to acquire as much real estate as we possibly can. And so when those prices begin to come down, we have some distressed properties. We want to be in a position to buy those distressed properties at those reduced prices. And then as the market begins to move itself back up, we increase our overall portfolio and we create financial freedom, right? Freedom comes from income. So if I'm receiving rent from my rental properties, that's income that I can use to free myself up from the day-to-day drudgery of going into and working in some areas that I don't want to work, right? Maybe you love your job. Maybe you enjoy what you're doing. But what you want to be in a position where you don't have to. Maybe you don't like your job, but you're making a lot of money and it's taking care of your family, but you want your time back, right? You want to be able to go to the soccer game and the football game and the basketball game, the recital. You want to be able to go to the spelling bee. You want to be able to go and volunteer at your kids' school and read. You want to be home when they get home from school to help them with their homework and help them grow and learn. You want to travel, right? You want to see the great nation of the United States of America, but you're stuck at a 50 or 60-hour work week. Buy yourself some freedom. Let us help you accomplish that. We want to encourage you to take a deep dive into this new formula. Use these strategies to put yourself in a position to take full advantage of the market reset. Once again, my name is Joel Huey. If you want some more information or you want to schedule a free consultation where we'll put together a freedom number for you, tell you exactly how much you need, what percentages, and where, click on the link below, schedule a free consultation, and remember, freedom ain't free.